Hey everyone, Eric Freeman, CPA, back again today. And today I'm going to talk about the difference between lower income when it comes to taxes, the wealthy when it comes to taxes, and the middle class. I did a quick search to see what currently the cutoffs are for low income, middle class, and upper income. And according to US News, the low income caps at about 52,000, and then middle class would be somewhere between 52,000 and 160,000, and then upper middle class would be 160,000 up to 375,000 approximately. Above that, according to this article, one would be considered rich or wealthy. I'm going to break down just real quick what it means from a tax perspective to be in each of those. So let's start off with, if you're in a lower income bracket, what your tax return may look like. If you're in the lower bracket, there's generally a lot more credits and things available. The recovery rebate credit was $1,400 per taxpayer. And then if you add any dependents, it was another $1,400. On top of that, you potentially would receive the advanced child tax credit. On a lot of these lower income individuals, you may not actually be paying any tax. In fact, these are refundable credits, which means you actually could get money back from the government. Another credit available is the American Opportunity Tax Credit. And this is an education credit. There's multiple ones. There's the lifetime learning credit. There's the education deduction. But the most beneficial one is the American Opportunity Tax Credit, which is up to $2,500 per student. And some of that is refundable. Some can only offset taxes that you owe, but that's a nice amount to receive back. Another credit you could potentially get if you have children is the credit for child care expenses. And this is up to $4,000 per child for up to 2 children. So that means if you max it out, you could get potentially $8,000 to cover your child care expenses. The last credit I want to talk about is the Earned Income Tax Credit. And this credit varies in dollar amount depending on the income level, as well as how many qualifying children you had. But it can range from anywhere from $1,500 to over $6,000 in credits back to you. So now let's move on and let's talk about what it would look like if you are in the, we'll call the upper income brackets. The capital gains rate is 20%. Compare that to the highest marginal tax rate, which you'll know if you go into our video on how the tax brackets work. But the highest marginal tax rate is 37%. But if you have capital gain income, the highest rate is 20%. Another item available to those in the upper income levels is 1031 exchanges. 1031 exchanges are when you sell a piece of real estate and you acquire another piece of real estate and you don't pay any tax on the sale. And this is incredibly common by those in the upper income classes because they generally own more real estate. And so, and especially investment real estate. And so they'll take advantage of this tax break. Another potential tax break that is relatively new is opportunity zones. Opportunity zones are where you invest in certain areas that the government is trying to incentivize, then you either don't pay capital gains tax when you make investments, and potentially you're not taxed on the gains from the investment there. We have a video that goes into more detail if you want to know how that works, but that's a new incentive that really is only available for the upper income individual just because you actually need capital gains or investment income in order to benefit from that. And generally, most of the upper income levels have that type of income. Another benefit is the home sale exclusion. The home sale exclusion is where you're able to exclude from your income the sale of your personal residence or the gains on the sale of your personal residence when it doesn't exceed $500,000 if you're married filing joint, or $250,000 if you're filing single. Another potential benefit is the new pass-through deduction. Pass-through deduction is a 20% deduction from income that comes from a pass-through entity, which generally means a partnership. It could be an S corporation, or the name's a little misleading, but it could be just a sole proprietorship that's reported on your individual tax return. You get this extra 20% deduction that effectively reduces your tax rate. If you own real estate, then you also get the benefit of depreciation deduction. Depreciation is a big deal because this is essentially a freebie deduction. When you own real estate, you essentially take the cost of it and write it off over time. And a lot of times you may be using bank financing or someone else's money and receiving the benefit of those deductions. So that can really help offset some other income items and make a big difference. And the last one I'm going to mention, and I'm focusing a lot on real estate, and it's just because there's just a ton of tax breaks and benefits for real estate. And the last one is tax-free refinance proceeds. So when you refinance a property and pull money out, that's not taxable income. So that's a huge deal because now you can take money out of a property, take some of that equity and put it into another project and generate more income. And so really the equity build is the creation of wealth, but it's not taxed. So that's another big item that the wealthy use to generate tax-free income. Now, when you're in what we call the middle class or the upper middle class even, so according to U.S. News, this would be somewhere in the area of, let's just call it 50,000 to 375,000, kind of a wide range. But when you're in that bracket, the type of income that is being generated a lot of times is typically, it's either W-2 income from your job, or maybe you own a small business that's generating some revenue. And if you're in that category, you're actually potentially paying some of the highest rates because you have a top rate of 37%. So depending on how you're filing, depends on when you hit that percent. But if all your income is from your job, you're paying these high tax rates. Plus, if you're self-employed, you're paying another self-employment tax on top of that, FCE for short, and that's over 15%. So if you take all of it together, plus your state taxes, you could be paying up to 50% of your income in those middle class thresholds away to tax dollars. So look at the difference. Lower income, potentially getting money back. High income, you notice there's a lot of exclusions and lower tax rates. So you're paying a very low percentage of your income in taxes, but then the middle class is getting hit hard on a lot of these tax breaks. And, a lot of people start to realize that as they move up in the income brackets, it's almost surprising how hard you start to get hit on the taxes. It's important knowing this to pay attention to knowing where you're at in the tax brackets, and then determining what's available to you in terms of credits, deductions, exclusions, things like that, so you can make the most out of it.